Knowing the difference between active and passive investing will play a tremendous role in building wealth, as it will save you thousands of dollars over a long-term horizon. Active investing refers to a methodology whereby time is spent researching individual stocks that will make up your investment portfolio. Over time, these individual stocks will be churned in hopes of finding better investment opportunities. One of the issues with active investing is the cost, transaction fees, or expense ratios if you are invested in a mutual fund. In addition, diversification can be an issue, as it will cost money and time to purchase the perfect stocks. Passive investing, on the other hand, is a methodology that does not require constant churning or tweaking as often as active investing. The best way to be a part of passive investing is by purchasing into index funds. There are various funds which have been set up to track performance of the following indexes: S&P 500, Total Stock Market, Total Bond Market, Sectors International Markets, etc. By investing in index funds that track the S&P 500, you essentially enjoy the performance of the publicly traded companies listed on the S&P 500. These funds are designed to offer diversification as well as market returns. At an average, the performance of the S&P 500 will outperform the performance of the majority of stock traders and investment gurus. The issue is that many of these professionals have failed to outperform the market year over year. One year, they may outperform the market, and the next they underperform. By investing passively and in index funds, you essentially set up yourself up to realize market returns, diversification, and free time that would otherwise have been spent researching and learning about individual stocks. The best part of passive investing using index funds is their low expense ratio. Many of the funds will have an expense ratio 0.05% to 0.40%, while actively managed funds will have expense ratios of 0.5% to 1.5%. Although this may not seem like much of a difference, it can sure add up to a lot of money over a 10-year or a 20-year period. Consider the fact that if you invest zero into a fund that earns you a constant 8% return year over year for the next 10 years, the difference between having your money into a fund with an expense ratio of 0.25% and one that charges 1.0% is around 500. Basically, your account would have 500 less at the end of the 10-year period if your money were invested in a fund with an expense ratio of 1.0%. The 500 less is around 7% lower at the end of the period. This demonstrates the impact that fees can have on your investment portfolio. My calculation was done on a 10-year period. It's much higher over a 20-year or even a 30-year period. 500 may not seem like much when considering the time range. However, this fee could be higher if instead of investing zero, you invested zero or even zero. Bottom line, pay attention to your expense ratios, as they can add up to a lot, and that any individual can start investing utilizing the passive methodology and do well.